All right, I want you to imagine something with me. You're 65 years old. You wake up on a Monday morning and you know what you do? Nothing. You don't go to work, you don't check emails, you don't answer to a boss. Instead, you check your bank account and there's $4,000 that just showed up. Dividends. Money your investments paid you just for owning them, and next quarter, another $4,000. And the quarter after that, same thing. You're making $16,000 a year, enough to cover a huge chunk of your expenses without touching the principal, without selling a single share, just collecting checks for owning good companies. Sounds pretty good, right? But here's the question nobody wants to answer. How much money do you actually need to make that happen? And more importantly, is it even realistic for a normal person to get there? That's exactly what we're going to figure out today using one of the most popular dividend ETFs out there, SCHD. We're going to run the actual numbers, show you the real math, and I'm going to tell you exactly what it takes. Here's the thing. Everyone loves the idea of living off dividends in retirement. I mean, it's the dream, right? Passive income, money while you sleep, financial independence. But most people have absolutely no idea what that actually requires. They just think, oh, I'll buy some dividend stocks and retire early lunches. And then they're shocked when their $50,000 portfolio is paying them like $1,500 a year. You can't live off $1,500 a year. I don't care where you live. So today we're going to break down the real math using SCHD, the Schwab US Dividend Equity ETF, which by the way is one of the best dividend funds out there. We'll get into why in a minute. But more importantly, I'm going to show you 3 different scenarios. Scenario 1. What if you want to replace a modest income? Let's say $40,000 a year in dividends. Scenario 2. What if you want a comfortable retirement? $75,000 a year in dividends. Scenario 3. What if you want to actually live well? $100,000 plus in dividend income. For each scenario, we're going to calculate exactly how much you need to invest, how long it takes to get there at different savings rates, and what the actual dividends look like in real dollars. Now you might be thinking, Brian, why SCHD specifically? There are tons of dividend funds out there. Great question. And that's where we need to start, understanding what makes SCHD special, because that's going to affect all our calculations. Look, I'm not sponsored by Schwab. They're not paying me to say this, but SCHD is legitimately one of the best designed dividend ETFs in existence. And here's why. Reason number 1, the yield is actually sustainable. SCHD currently yields around 3.4 to 3.6%. Now, that might not sound exciting compared to some of these 7 to 8% yield funds you see advertised. But here's what most people don't realize. High yields are often a trap. When you see a fund yielding 7 to 8%, you need to ask, why is it so high? Usually it's because the companies are paying out too much of their earnings, or the stock prices have crashed because the businesses are struggling, or they're using financial engineering to juice the distributions. SCHD focuses on dividend growth, not just high current yield. According to Schwab's own fund data, SCHD has increased its dividend for 11 consecutive years. The companies in SCHD have raised their dividends an average of about 11 to 12% per year over the past decade. That means your income grows over time, which is crucial for fighting inflation. Reason number 2, the holdings are quality companies. SCHD doesn't just buy anything that pays a dividend. The fund tracks the Dow Jones US Dividend 100 Index, which screens for companies based on dividend yield, dividend growth, dividend coverage, and return on equity. As of the latest data, the top holdings include companies like Chevron, Amgen, BlackRock, Merck, PepsiCo, Coca-Cola, Texas Instruments. These aren't speculative plays. These are established, profitable businesses with moats. Reason number 3, the expense ratio is tiny. SCHD charges 0.06% per year. That's $6 for every $10,000 invested. Compare that to actively managed dividend funds that charge 0.5 to 1.0%, and over 30 years, that fee difference alone can cost you hundreds of thousands of dollars. Reason number 4, the track record is solid. Since its inception in 2011, SCHD has returned about 12 to 13% annually on average when you include both price appreciation and dividends. That's beaten the S&P 500 in many years, and it's done it with less volatility because dividend stocks tend to be more stable. Now, past performance doesn't guarantee future results. You've heard that disclaimer a million times. But a 13-year track record of consistent dividend growth and solid returns is about as good as you're going to find. So when we run our calculations today, we're using SCHD because it represents a realistic, sustainable approach to dividend investing, not some pie-in-the-sky 10% yielding garbage that's going to cut its dividend the moment the economy hiccups. All right, let's start with a modest but meaningful goal. $40,000 a year in dividend income. For a lot of people, especially if you have your house paid off, Social Security kicking in, maybe a pension, $40,000 in dividends could be enough to live comfortably. So, how much do you need invested in SCHD to generate $40,000 per year? Here's the formula, and it's dead simple. Required investment equals annual income needed divided by dividend yield. SCHD's current yield is about 3.5%. Let's use that. $40,000 divided by 0.035 equals $1,142,857. So you need roughly $1.14 million invested in SCHD to generate $40,000 per year in dividends at the current yield. Now, I know what you're thinking. Brian, that's over $1 million. How the hell am I supposed to save that much? Stay with me because this is where it gets really interesting. Let's say you're 30 years old right now and you want to retire at 65. That's 35 years to build this portfolio. If you invest $500 per month at an average 10% annual return, which is conservative for SCHD historically, after 35 years, you'd have approximately $1,897,000. Let me say that again. $500 a month, which is $6,000 a year, totally doable for someone making $50,000 to $60,000, gets you to nearly $1.9 million in 35 years at 3.5% yield. That's generating $66,395 per year in dividends. You've blown past the $40,000 target. If you invest $750 per month after 35 years at 10% return, you're looking at approximately $2,845,000. That's generating $99,575 per year in dividends. If you invest $1,000 per month, which sounds like a lot, but it's totally achievable if you're intentional about your spending, after 35 years, you'd have approximately $3,794,000, generating $132,790 per year in dividends. Here's what most people don't realize. The hard part isn't the math. The math is simple. The hard part is the discipline to actually invest that money every single month for 35 years and not touch it. Because here's the thing, life happens. The car breaks down, the roof needs replacing. You want to take a vacation. And every time, there's a temptation to skip a month or dip into the investments. But that's where the magic gets destroyed. Because when you're looking at 35 years of compound growth, every dollar you invest early is worth multiples of what you invest later. $1,000 invested at age 30, growing at 10% for 35 years, becomes $28,102. That same $1,000 invested at age 50, growing for 15 years, becomes only $4,177. Same dollar, but timing makes a 6 to 7 times difference. All right, let's level up. What if you want a more comfortable retirement? Maybe you want to travel, enjoy nice dinners, help out your kids or grandkids. You want $75,000 a year in dividend income. Using the same formula, $75,000 divided by 0.035 equals $2,142,857. You need about $2.14 million invested. Now, that's a bigger number, but it's not impossible. Let's run the scenarios again. Starting at age 30, if you invest $1,000 per month for 35 years at 10% return, you get to approximately $3,794,000, which generates $132,790 per year in dividends. You're actually overshooting the $75,000 target by a lot. If you invest $750 per month, you hit approximately $2,845,000, generating $99,575 per year, still well above $75,000. If you invest $600 per month, you'd reach approximately $2,276,000, generating about $79,660 per year in dividends, right in the ballpark. So to hit $75,000 in annual dividends, you're looking at saving roughly $600 to $750 per month starting at age 30. Now, you might be thinking, but Brian, I'm not 30. I'm 40 or 45 or 50. What do I do? Great question. Let's adjust the timeline. If you're 40 years old and want to retire at 65, that's 25 years. To reach $2.14 million in 25 years at 10% return, you need to invest approximately $1,650 per month. That's a bigger monthly commitment because you've lost 10 years of compounding. Every year you wait, the amount you need to save per month goes up significantly. If you're 45 years old, you have 20 years. To reach $2.14 million in 20 years, you need approximately $2,800 per month. If you're 50 years old, you have 15 years. You'd need to invest approximately $5,300 per month to hit $2.14 million. See how this works? The later you start, the more painful it gets. This is why I'm so frustrated when I see people in their 30s and 40s not taking this seriously. You have time as your biggest asset and you're wasting it. But here's the thing. Even if you're starting late, you still have options. You might not hit $75,000 in dividends, but you could hit $40,000 or $50,000, which combined with Social Security might be enough. The worst thing you can do is nothing. All right, now let's talk about the big leagues. What if you want to live really well in retirement? $100,000 a year in dividends, maybe $150,000. $100,000 divided by 0.035 equals $2,857,143. You need about $2.86 million invested. $150,000 divided by 0.035 equals $4,285,714. For $150,000 in annual dividends, you need about $4.29 million. Now, these are big numbers, but they're achievable if you start early and save aggressively. For $100,000 per year in dividends, starting at age 30, investing $900 per month at 10% return for 35 years gets you to approximately $3,414,000, generating $119,490 per year. For $150,000 per year in dividends, starting at age 30, investing $1,350 per month for 35 years gets you to approximately $5,121,000, generating $179,235 per year. Here's what's crazy. $1,350 per month is $16,200 per year. If you're making $80,000 a year, that's about 20% of your gross income. Is saving 20% of your income hard? Yeah. Is it impossible? Absolutely not. And here's where the psychology comes in. Most people look at saving $1,350 a month and think, I can't afford that. But what they really mean is, I don't want to change my lifestyle to make that happen. Because here's the truth, almost everyone can afford to save way more than they think. They're just unwilling to make the trade-offs. You don't need the new car. You don't need to eat out 4 times a week. You don't need the $200 cable package and every streaming service and the premium gym membership. I'm not saying live like a monk, but if you actually tracked where your money goes, and most people have no idea, you'd find that there's a ton of waste. Money going to subscriptions you don't use, food you throw away, impulse purchases that sit in your closet with the tags still on. According to a study by Ladder and OnePoll, the average American wastes about $1,497 per month, almost $18,000 per year, on non-essential purchases and unused subscriptions. If you could recapture even half of that waste, you'd have $750 a month to invest. That alone, over 35 years, builds a multi-million-dollar portfolio. The difference between retiring wealthy and retiring broke often isn't income, it's discipline. Now, here's where this gets really exciting, and it's something most dividend calculators don't account for: dividend growth. Remember how I said SCHD's holdings have increased their dividends by about 11 to 12% per year on average? That's huge. Let's say you retire at 65 with $3 million invested in SCHD, generating 3.5% yield. That's $105,000 in year one. But if the dividends grow at just 6% per year, which is actually conservative compared to SCHD's historical growth, here's what happens. Year 1, $105,000. Year 5, $140,000, $469. Year 10, $201,418. Year 15, $288,882. Year 20, $414,383. By year 20 of your retirement at age 85, you're collecting over $414,000 per year in dividends on that same $3 million portfolio. Your income has almost quadrupled, and here's the beautiful part: you never had to sell a single share. That $3 million is still sitting there, probably worth way more than $3 million at that point due to price appreciation. This is what most people don't realize about dividend investing. It's not just about the income today, it's about building a growing income stream that protects you from inflation and actually improves your lifestyle over time. Meanwhile, if you had gone the traditional route of just accumulating index funds and selling 4% per year in retirement, your portfolio is shrinking every year, and if you hit a bear market early in retirement, you could run out of money. With dividends, even if the stock price drops 30% in a recession, you're still collecting your quarterly payments. The companies keep paying, your income stays relatively stable. During the 2008 financial crisis, SCHD didn't exist yet, but the types of companies it holds, your Coca-Colas, your Johnson & Johnsons, your Procter & Gamble's, most of them maintained or even increased their dividends through the crisis. That's the psychological advantage of dividend investing. When everyone's panicking about market drops, you're just collecting your checks and maybe even buying more shares at lower prices. All right, let's make this real simple with an actual plan you can start today. Let's say you're 35 years old, making $65,000 a year, and you want $60,000 a year in dividends at retirement. You need about $1.71 million. Sounds crazy, right? But over 30 years, you only need to invest $650 per month at 10% average return. That's 12% of your income. Totally doable. Here's what you do. 1. Automate it. Set up automatic transfers the day after you get paid. You can't rely on willpower. 2. Start with whatever you can. Can't do $650, start with $300. Start with $100, just start. 3, every time you get a raise, increase your investment by 1%. You won't even feel it. 4, don't touch it. Market crashes 30%, keep investing. Those are the moments that make you wealthy. Look, the median American near retirement has saved only $163,577. You know what that generates in dividends? About $5,700 a year. You cannot retire on that. But if you commit to this plan right now, Automate it, stick with it, let it compound. You can build $1 million portfolio that pays you for life. 20 years from now, you're going to wish you started today. So start today. If this helped, hit that like button and subscribe. Drop a comment with your dividend income goal. I'll see you in the next one. Now go build that portfolio.